viewers right now, it says. All right. If anyone out there is following this, we're just testing sound and picture. Can you see me now, Liam? And hear me? All right, bye. All right, thank you, Liam. All right, for those of you out there waiting, we have tested sound and picture. It seems like everything is going fine live right now. I'll just mute myself and I will get back in 5 minutes when we start. All right, now there, we'll just go live in about 1 minute, just waiting to see if some more people will hop on. All right, let's give them 30 seconds more and we will start the webinar for tonight. I can see some people starts to come in now. If my sound and picture goes through nicely, please write a 1 in the chat so I can see if you can hear me out there. Let me know in the chat with a 1 if you can see the picture, see my screen, and hear the voice. All right. Hi again, Klaus. All right. It's 7 o'clock. Let's start out. Some of you were here last night. This will basically be the same, just in English. We're going to have a look at 2 different strategies. Yesterday, the webinar was about 30-40 minutes, and I suspect we'll be at about the same time today. It's not the most complicated strategies, but they are quite effective. So what are we doing here? Well, we are looking at investing with stock scores. And what are the stock scores? Well, I have put them on the front page of my slide here. But if we go into our website here and we choose a stock, it could be Tesla. Let's look up Tesla here. We can see that up here in the right corner, we have some value, quality, momentum, and stock scores. Tonight, we're going to focus on value and quality. As you can see, there is a US and a North America up here. That means that when we look for value, and I will explain how we get to the value and the quality score here tonight, but when we look at value for Tesla, it is showing that Tesla is only of higher value than 9% or 8%. It is in the 9% range here. So it's better than 8% of the stocks that we compare to in United States. Now, in North America, it's also 9, and that is because the region here is almost equals US, because there's only Canada and Mexico in here other than United States, and the US is just a massive amount of stocks, massive liquidity. So these are almost always the same. You can see a bit of difference here with momentum, but this is where you find the stock scores. As I said, we're going to have a look at value and quality tonight. So let's dive into it and just write your questions if there are any. It's good to have you here tonight. There are 3 days to Christmas here in Denmark. If you celebrate it the 25th, of course, there are 4 days. So let's get into it. The value score and how can we use it to invest with. Now, if we're looking at the value score, we have some different components. And these are probably some components that you know, most of them. At least we have the price earning. That is, of course, one of the most common ways of trying to measure the value of a company. That is the price, that is the P here, and earnings, of course, what is the earnings per share. So if the price earning is 50, well, then it means that investors are willing to pay $50 for every $1 of profit there is in the company. So price earning, and I should say, when we do the value score, when we do all the scores, we take each of the components here, and then we say, okay, price earning. A price earning, in the rule of thumb is that a low price earning is better than a higher price earning, because you would have to pay less dollars for $1 of profit. So if a price earning is 10, you're basically getting a 10% yield, meaning for every $10 you're putting into the stock, you're getting one out in profit. And of course, if the price earning is 20, well, then the yield is only 5%. It's not necessarily the best stock to buy to go for a low PE, but overall, a low PE is better than a high PE because you get a better yield. Price book, I've written it in Danish here for those of you that are Danish, but price book is basically to say, all right, am I paying more or less than the book value of the company? This book value can be a bit hard to calculate, and companies can do all sorts of smart tricks to manipulate that book. But again, a price book, if you're paying less than the actual intrinsic value of the company, everything equals, a low score here is better. Again, it is measured towards all the other companies that we're looking at and put into a bracket between 1 and 100, where 100 is the best. Price to free cash flow, well, they are all a bit like the same. You could think that price to free cash flow is a bit like price earning. However, free cash flow is a bit harder to manipulate when you're doing the earnings reports. Free cash flow is what is in your little cigar box at the end of the day. That is the cash you can actually use for something. You can pay out dividends, you can reinvest, you can buy back your own shares or whatever. So price to free cash flow is a way to measure the value of a stock. Forward dividend yield, it kind of gives itself. Price to sale is often used when you're, for instance, in a sector, in an industry group where there's not too much earnings. Maybe there's an entire new sector or industry group that is not really making any profit yet. So it can make sense to look at price to sales. And lastly, we have EV to EBITDA. EBITDA is, of course, earnings before interest, taxes, and what is the last ones? I can't recall them here. But this is a way of measuring earnings here. And EV is the enterprise value. So all of these are kind of the same way of telling, is this a good value stock? Are you paying a reasonable amount for the stock? Now, that is all well and good, but how do we use it to invest with? Well, first of all, let me show you the stats for this strategy that I am going to show you now. We have tested this back from 2000. We could go further back, but after 2000 is where we are most confident that the data we have is valid. And as you can see, 16.11% is what this strategy has made every single year. Not every year, of course, but in compound annual growth rate. So it is kind of the average performance it has made, 16.11%. compared to the S&P 500, 6.67%. Now, that is a huge difference over 20 years. And you can also see that the Sharpe and Sortino ratio, they're fairly good. If you don't know it, the Sharpe ratio is where you take a look at the CAGR and combine it to the volatility, meaning the swings up and down from day to day and from month to month in the portfolio. So that gives you a Sharpe, and that kind of tells you a picture, shows you a picture of the risk adjustment return, meaning how much volatility risk are you actually taking to get this return. So 16%, we all want 16% per year. That is almost Warren Buffett-like performance. However, the max drawdown is 67%, and that is a bit hard to stomach. I think all of us can easily fall in love with the 16%, and I have seen tons of people saying, just give me 16 or 20 or 30% per year. I can easily stomach 50 or 60% drawdown. The fact is you can't, or at least most people can't, because when you're sitting there, you have put $1 million or 2 million or 500,000 into a strategy that looked good on paper, and all of a sudden you're down 50%, which is half of what you need for retirement. So, and 67%, if you put in $1 million, you'd only have 340-ish thousand left. The thing is, you never know when the max drawdown is hit. So if you just knew this would be the absolute maximum, it might not be a problem. But again, this is just a historical backtest, so it might be 95% next time. So 67%, that is simply too high, and I'll have a look at later what we can do with it. But as you can see, we have the biggest drawdown of the strategy back in 2002 and 3 here with the dot-com crash. We have the massive loser here, the drawdown in 2008 and 9 under the financial crisis. We had some in 16, some in 19, and then of course there was a corona crash here with a big drawdown, and again 22 and 23. So we have had a lot of drawdowns here. If you would have been able to stomach it, you would have made some very decent returns. Now, if we look at the annuals here, you can see that, well, this year, 23, we have not really done as well as the market, only about half of the performance as a market. Last year, it was only down 6%, whereas the market was down 18%. And so you can see it doesn't beat the market every single year. In 2020, this strategy was down 14% and the market was down 18%. So that was a 32% difference, which might be a bit too much for some people. But looking overall over the last 23 years, this has been a massively winning strategy. So how do we use it? Well, it is quite simple. Let's have a look in here. We go into my stock scanner. We use the screeners, and if we should start up a new screener here, we just press new screener, or here, if you don't have this many, you just press new screener up here. But I have one called new screener here. We're looking at United States and dollars. If you have some other set as default, of course, you can just pick United States. We have only tested this on United States because that is where we have the most valid data far back in time. Yesterday, of course, I got the question. We had the webinar in Danish yesterday, and I got the question if this could be used in Denmark or Scandinavia or UK or France or whatever. And I think it can, but it's not something I can show you a back test of. And that is something we are definitely working on. Anyway, here we have all the stocks in United States. Now we need to add a rule here. When we press add rule, we need to, now I have it here, but if you don't have it, you just press index and choose index member. You update, and in here, you need to select the S&P 500 and the NASDAQ 100. So let's have a look. We have the NASDAQ 100 there, and we have down here the S&P 500 index. Here we go. This means that the stocks we're getting here are only the stocks that are a member of either NASDAQ 100 or S&P 500, or both, of course. What we do now, since we're looking at value, we are going over in layout. We are choosing value here. And we get all the country value scores here. We press this one to sort them. And now we have all the value scores with the best value score at the highest. And what you do now is that the first of every month, meaning you can do this at the last trading date when the market is closed and the data is updated, you can do this and you can look at the value scores, and you just need to count to 15, because you are going to take the 15 best stocks of these and buy them. And that's it. Then you hold them for a month. And after a month have gone by, you make a new screen and you see, has anyone been kicked down to maybe number 20 or 30 place, and a new stock has taken its place. Then you just shift the stock, sell one, and buy a new one. As you can see just in a second, there's not too much circulation here. We're not reallocating very much money, but this is basically it. I'll get back to the holding periods for the individual stocks. But what you can see here is you do this once per month, and looking at the positions here, you can see that the days held, let me see, we are at the top here. There's one here held 119 days, 228, couple of 55 days. We have 446 days, and so on and so forth. and that means that you are not there. There will be months where you're not even reallocating any money. You're not buying and selling. You're just looking at it and say, okay, and again, it makes sense since these are we have quarterly data, of course, and that means that sometimes it'll be 1 month or 2 months since we have gotten some new earnings data, meaning that we are just sticking with the stocks we already have. So there will be months where you are just doing this. It takes 5 minutes the last day of the month, and you can see, oh, I don't have to do anything, and you just leave it a month then. And that is what gives you this amazing 16%. Are there any questions for this one? Because otherwise I'll jump to the quality score strategy, which is very much the same, but with of course, another focus. And we'll just have a look at that in a second. Let me know if there are any questions for this. Just write them in the chat. All right. Well, let's have a look at the quality score then, because there is a bit more components to that, but there's nothing here that I think will surprise the most of you. In the quality score, we are doing the exact same thing as with the value score, ranking each item from 1 to 100, and then maybe let's say in the value score that a certain stock got a 50 out of 100 in price earning, and only a 30 out of 100 in price book, but 70 out of 100 in price to free cash flow. Then we add all the scores up, divide them by 6, and that is the overall value score. With quality score, it's exactly the same, just with more components here. And as you can see, what we're looking for in the quality score is if there is a decent earnings quality in the company. We're looking at the gross profits to assets. So are they doing a fair amount of profits compared to how many assets they have? The average return on capital employed, and average is over 5 years. The ROCE is one of the, in my opinion, most important ways to quickly assess if a company is doing well. Is the ROCE, return on capital employed, is that going up or down? The average free cash flow to assets, also a very important. As you know, I do like the free cash flow part. Operating margin stability. Well, here we are looking at we're looking at the volatility within the operating margins. So are they fluctuating wildly? Are they jumping up and down? 1 year it's 2%, next year it's 70%, and then it's 30%, and then it gets a low score. We like a constant, we like stability. The same with sales growth consistency. Is a company growing their sales by a certain amount every year, or is it all over the place? Sales growth overall over the last 5 periods, that is 5 years here. Again, earnings per share growth over the last 5 years. Net debt to assets, and right now that is actually an important topic, because of course it's never good if a company has too much debt. But of course, it depends on what they use the debt for. Because if they can borrow money for 3% and they can have a return on capital employed at 20%, then of course they're making a lot more money on the money they employed that they pay in interest rates. However, with the increasing interest rates, I know the interest rates are about to drop probably here in 2024, but with the higher interest level in society, this debt to asset is a bit more important. The Petrosky score and Altman C score is something we can find in here. Let's just have a quick look at one of the companies. The Petrosky score is what is called the company health, because it's called the Petrosky F score. And the thing it does is it measures 9 different points. You can read more about them here and see what it is. It was I think he was a professor. He was a teacher in finance and earnings report and all that for accountants many years ago. And his name was Petrosky, funny enough. And therefore he came up with this score and saying the more points it gets 1 point for each of the topics you can tick off a yes to. And a score at 6 or above is very good, and is normally a sign that a stock can go up. So the Petrosky score is a part of the quality score, and then the Altman C score is a way of measuring how financially solid a company is. And if we look at that, it is looking at a lot of different things: EBIT to total assets, working capital to total assets, market value to total liabilities, and so on. So basically looking at is it too much leveraged, this company? And you can see with this one, Synchrony Financial, well, we can see that the Altman C score is fairly low, not in distress, but on the way. However, with a lot of financial companies, we cannot really use it. So it was actually kind of a bad example here. But that is something to do with that the amount of assets they have in the company are often very large due to customers' money and so on. But these are the two, Petrosky score and Altman C score, that is also used here in the quality score. So again, rank from 1 to 100 with each of these and taking the average of it, that is what gives us the quality score. I think this one is, can't even recall which one I picked, maybe Novo Nordisk here, a Danish stock that had 100 in earnings quality. So let's see what we do. How do we work with the quality strategy? Well, first of all, here we have a bit of a lower performance. We have 14.4%, but that is still very good. Compared to the S&P 500, 6.6% in the same period. And as you can see, even though from roughly 7 to roughly 14% doesn't sound like that much, but again, over 23 years, it compounds into some quite solid earnings here. You can see the Sharpe ratio, if we just compare the two here. This is the value strategy. It has a Sharpe ratio of 0.78, meaning you're getting a reasonable, good risk-adjusted return. If we're looking at the quality strategy, that is lower. So is the Sortino ratio. However, a very important thing for many people would be the max drawdown here is only 47%. We can see that it had drawdowns in the dot-com crash. It had definitely some massive drawdowns here in the financial crisis. And then, of course, in 2020 and here in 2022 and 2023, also some quite dramatic drawdowns. But the max drawdown is quite a lot lower. You can see 47% compared to 67% here. But I'll show you how we can maybe use a bit of combination here. And I should say that between Christmas and New Year here, we haven't a date in the calendar yet, but I suspect it to be the 28th of December. We'll have a special webinar only for paying members where we are going into some very, very interesting combinations between these different stock scores. But these are some very solid strategies, and I'll just show you how to find the quality candidates that you might choose to combine with value candidates. Let's just have a quick look in here. And just as before, you are choosing the US market. You're choosing that it has to be an index member of NASDAQ 100 or S&P 500 here. And then instead of using the value score, the layout value here, you just go in here, you choose quality instead. Here, you make sure that you rank it. So the highest is on top here with 100. And then you pick the 15 best. And that's it, just as with the value score. And as you can see, I don't know if you remember the others from the value score, but these are different stocks. I don't think there is one single duplicate here. There could be in theory, but not too often. And that means that if you're combining these, you're basically diversifying out on 30 different stocks. But that could, of course, be a stock that is in both group, no doubt about it. But here you're getting some massively good quality, and you are just as with the value strategy. The first in a month, you are looking down on the list to see have any of the stocks I bought last month dropped out of the 15 best. If so, you sell them and you buy the new ones that are in the top 15. Now, if we're looking at this, and we're looking at the annuals here, like this, we can see that we might not get rid of our drawdown completely. We need some of the other strategies that I'll tell you about between Christmas and New Year for those of you that are paying members. But we can definitely do something here, because some of these years, as you can see, are fairly bad. As I said, this one is underperforming quite massively. However, if we are combining them with the other strategy, here we have the quality strategy that is doing 31% this year. Well, combining with the value strategy that did 13%, that would give us 22-23% this year if you put half of your money in each strategy, which kind of equals the market here. What about 22? Well, it gave us about, the value strategy gave us about 6% here last year. If we're looking at the quality strategy, well, that was minus 25. So minus 25 and minus 6, that gives us roughly a negative of 15-16% last year. Still quite bad, but not as bad as the overall market. What about 21? Well, the quality strategy gave us almost 37% here, whereas the value strategy, well, they were basically almost the same. They were both in the very high end. But the value strategy did quite poorly in 2020 with negative of 14%, whereas the quality strategy did 32%. So that would have equaled out a lot of the underperformance from 2020. And you can go each and every up here each and every year. Let's just have for fun of it 2008 to see how that ended. I suspect they are both fairly bad here. Quality minus 30%. And let's just have a quick look at the value. Yeah, that is just up in that range as well. Then in 2009, when everything turned around, you could really find some good value, and the value strategy made a whopping 142%, which is absolutely crazy. Whereas the quality strategy only, quote unquote, gave a 34%. So that would still, in combination, have been around 70%. So when I'm talking about these combinations, it also to show you a bit about how I use diversification, because normally when you're talking to your bank, to a financial advisor, which I'm not, neither of them, they normally talk of diversification as something where you need to spread out on a certain amount of stocks, and they usually prefer 20 to 30 different stocks. And then they also talk about spreading out on different markets, for instance, something in US, something in Europe, something in Asia, whatever, BRIC countries. But what I do is a bit more complex than that, because I also use different markets, like I just said here, but I also use different strategies. So instead of just buy and hold 30 different stocks in different markets, I use different strategies that have different strengths and weaknesses, so that I know that the correlation between them are fairly low, meaning that I can actually, when one have a dip down, there could be some of the other strategies going up. Now, that is just for stocks. Personally, I'm also trading some currencies, and that has been very good this year. And when the stocks are down, it is fairly easy to find some good currency trades, for instance, to have. One of my best strategies this year have been my option strategies, where I'm doing both something called cash secured put, covered calls, but also a lot of credit spreads. And that have yielded me a lot this year. I am doing something like 5% per month this year, which has been quite amazing. For those of you interested, there will be some option courses in the beginning of the new year here, but keep an eye out for that. But that is just to say that I am diversifying on different instruments, options, stocks, some ETFs, some currencies, and also on different time frames and on different strategies. And that makes my performance a lot more stable than if you just put all your money in the stock market, for instance. But I know it's a bit complex, and I know that there's a lot of moving parts. So if you want to keep it relatively simple, you need to pick some strategies. And in the beginning of the new year, we will have, I've mentioned that in a couple of webinars, we will have what is called a portfolio mixer, meaning that a lot of our different strategies, and I'm showing in these webinars, hi there, one play two fun, if that's your name. The strategy mixer is where we have a number of different strategies, and then you can attach a percentage to each of them and say, all right, I want 30% of my money in this strategy and 20 in this and 50 in this. And then you can see the entire equity line, draw down everything for the last 23, 24 years if you have been allocating your money in with this percentage in each strategy each and every year. So that is something coming up here. And then, of course, you can just say, okay, now I'm satisfied with the results. Please send me an email when something new happens in that portfolio. So that is one of the tools we are working on building right now in my stock scanner. Are there any questions about the quality strategy or the value strategy overall? As I said in the beginning, they are fairly simple. You just pick S&P 500 and Nasdaq companies, and then you choose quality or value, and you choose the top 15. You say, I have about 20 strategies that works on Nasdaq and S&P 500 futures. What type of money management should I use? Fixed lots for each trade? Well, that is a bit of a more complex question. I can tell you that what I do is that instead of having a fixed amount attached, I have a fixed percentage of risk. And just to not complicate it too much, so let's say we have a stock, and I know this is a stock and you're talking about futures here, but that can be used as well. If I have a stock at a cost $100 and I want to risk 2% of my overall capital, if my stop loss is hit, if it's a strategy that uses stop losses, then I calculate, let's say I have $100,000 in the account and I can maximum risk 2%. That is $2,000. Then with the stop loss I have, I calculate, that could be in points with futures or in pips with Forex or just in dollars with stocks. I say, okay, if my stop loss is $10 down and I can risk $2,000 per trade, well, then I can buy 200 stocks. So I am deciding my position sizing from my risk size, and what sort of risk you should risk per trade depends a lot on your strategies, because you say you have about 20 strategies that works on Nasdaq and S&P 500, and that's great. What you might have done, or I don't know if you have developed the strategies or someone else has, but the developer of these strategies have probably run something called a Monte Carlo analysis on it. And that is something where you are taking the win rate, the win size, and the loser size, and then you're putting it into a randomized simulation where you say, okay, randomize 50 different trades for me from the stats I have here, and do that 1,000 times, for instance. And that shows you what is the best and the worst case statistically. And maybe if you have planned to risk 2% per trade, and doing a Monte Carlo analysis, you can see, okay, there's actually a 50% chance that I will have 15 losers in a row. All right, there might be a 90% chance that I hit at least 10 losers in a row. And then you can start to adjust your risk per trade in regard to how many losers in a row is likely. If you can see, you can easily have a winning strategy where you only have a win percent of 20, but where your winners are enormous and the losers are very small. And yes, risk of ruin is definitely a thing that is normally tested in this strategy. But it's just to say that you can easily have a strategy that wins only 20% of the time, but your winners might be 10 times as big as your losers. So it is profitable. However, you cannot risk as much per trade because if you have only 20% win rate, that means you will have a very large amount of losers in a row quite often. And that means that if you're looking at 20 losers in a row, then you might not want to risk 2% of your capital per trade, because that means you get a drawdown of 40%. So that is an entire universe of itself. I'm doing a lot of testing. I have different software packages. We have our own, and there I have several packages I also lease that we are using for these strategies, both for Forex. I'm not trading futures myself, but it could be used for that, for stocks, intraday, end of day strategies, and so on. Would be better, limiting the number of open trades, for example, 3 strategies at a time maximum, or allow all strategies to work at the same time and having as many as 20 open trades? Again, that is a hard question, because that depends a lot on, well, first of all, your fund size, because if you have $10,000, it might be a bit much to have 20 open trades at a time. But another thing it depends a lot of is the correlation between the strategies. That is something I'm doing a lot when I'm constructing a portfolio of strategies, because if there's not much correlation between them, it means that it is, or let me say, if there's a very high correlation between them, it means that they move in tandem. So when, let's say you have 20 strategies in the S&P 500, and they are on the same time frame and kind of the same sort of strategies, then you would often see that when S&P 500 moves in one direction, you get all sorts of trades alike. And that means that you're basically just taking 20 times as much risk as you would normally do. However, if your strategies are on different time frames, some of them are trend following strategies, some are mean reversing strategies, and so on and so forth. Some are on 10-minute time frame, some are on daily, some are on 4-hour. Then you might set 20 strategies to run at the same time. But I would say it takes, you really need to have done your homework and know how they work together. I know several of the people I'm talking to that are working with algorithms that have 15, 20, some of them 30 or 40 strategies running at the same time. But they have done massive work on making sure that they are not correlated and they are tracking them all of the time. I would say personally, if I hadn't developed the strategies myself, and I would probably start with 3 strategies and see how they work together. But that is just me. I don't know the strategies and your risk tolerance and all that. So it is hard to say exactly. I think I need to add more trend following strategy, because a lot of my strategies are mean reversion. Well, I love mean reversion strategies, especially in S&P 500 and NASDAQ 100, because these indices are just mean reverting. It is. I know we're just coming out of an S&P 500 that have gone up, I don't know, 10 days in a row and 8 weeks in a row. So you could ask yourself, is this really mean reverting? But over time, historically, S&P 500 is mean reverting. So that is definitely a strategy that if you have several mean reverting strategy that doesn't correlate too much, then it can be a very robust portfolio of strategies, definitely. We are a bit out of the range of just the quality and value here. Well, mean reversing is like catching a falling knife. It depends a lot, because I am not a fan of the catching a falling knife, and that is why I say that the large indices can be good to use mean reversion strategies on, because they have a tendency of mean reverting. Whereas if you are looking at a stock some of these stocks that have been just completely crushed down, some of the small tech stock, Teladoc, whatever, some of these stocks, maybe some of them that were great under the corona crisis and so on, having tried to mean revert trade these is definitely not a good idea. So I never use mean reversion of single stocks. But my point is that doing it on a large index can actually be a more secure way of doing it. So, but I never add to losers. I never, if I have a stock that someone, Katie Wood or whatever, have recommended, well, that's never my reason to buy a stock. But if it was, and it started to drop 10 or 20%, I always have a stop loss and it's just out. If it's not a part of these quality and value and momentum strategies. But if I'm just investing in single stocks, trying to swing trade or a bit longer term trade them, I have a stop loss. And if they drop through that, I sell it. And I never start to add to losers because that is just about the most dangerous thing you can do on a single stock strategy, in my opinion. All right. Anything else? We have been through the quality strategy and the value strategy, and there have been some very good questions here about position sizing and so on. Let me know, are there any other questions to the strategies? There will be screeners for these strategies, or you can, as you can say, very easily build them yourself in here in the screener area and in my stock screener. But the strategies that we will introduce here between Christmas and New Year for the paying members are combinations where we are ranking the different stock scores in a bit of a new way, where we are combining value and momentum, or quality and momentum on some new ways. And the results are quite amazing. So let me know if there are any more questions to the platform or to the strategies that I have introduced here tonight. I've been talking now for 40 minutes, and that is basically what I had anticipated, the 45 minutes. That was what it took yesterday. If there aren't any more questions, I would say thank you for all of your time. It has been a pleasure having you in here. And if you're not already a paying member or have used the My Stock Scanner, there is a 14-day free trial in there, and you can pop in and test it. And if you have any questions for it whatsoever, feel free to write us in the support section, and we'll get back to you very quickly. All right. That's it for tonight then. Have a nice night. Have a very Merry Christmas and a Happy New Year to those of you that I'm not in contact with before. Take care of yourself and your money out there. Bye for now.